Welcome back, YouTube. My name is David Mitchell. I am the host of the Ace of Spades. So today I'm going to be speaking about primarily when to invest. Now, almost every time when I post a stock video, there'll be someone in the comments saying, okay, hey, I'm just getting started, or I'm new. What advice do you have? And I think the most important topic to be discussed is primarily when to invest in the market, because usually the new people that I'm seeing, they're typically on the trending stock videos, or a company that just went bankrupt, or there's some type of scandal and there's easy money to be made, and they're saying, hey, I'm a new investor, how do I make money, or what do you think I should do now, whatnot. And those are the riskiest stocks to actually be getting started in as a new investor. So this video is going to discuss in detail the best way to add some balance to your portfolio and some little more stability. And I'm going to give you some scenarios as well. When it comes to stock investing, I like to break investors up into two categories. Those that try and time the market, I call those speculative investors. And those that invest consistently, I call them dollar cost averaging investors. The truth of the matter is most investors lose money in the market because they're trying to time it or doing speculation investing. And the truth of the matter is that is no way to have sustainable growth over time. Now, I do this on occasion because there is money to be made, and I think that's part of the lure to get new people in, and that's consistently why this keeps happening. But as far as your overall portfolio, or letting that be the main method of your gains for your portfolio, that's extremely dangerous. And you may occasionally make money, but those losses you incur will usually wipe out any gains that you see. When you do that type of investing, the amount of money you make in your portfolio will always be swinging wildly, and you'll always be chasing the next big thing. Because in order for it to be quick money, there's going to have to be some type of initiative. The company is going bankrupt, or their CEO got fired, or there's an investigation and the stocks crashed and now it's below value, fair market value. Oh, we're going to pump and dump it. Like, there has to be something going on. And that type of investing is going to lead your portfolio to be all over the place, and you're going to be consistently chasing the next high pretty much. A common term that you're going to hear is buy low and sell high. Well, how do you determine what is the high and what is the low? If you are one of those investors that do speculation investing and you're chasing the news of a bailout injection or the new coronavirus vaccine, how do you know when to get in? The truth is you don't, and you can't. You can't time the market, and you don't know as far as what's going to happen. The market is an emotional roller coaster that can change in the blink of an eye. And most people that lose money in the stock market are those that try and time it. A proven method of success are those who invest consistently over the long term in strong companies that will have a future. I have seen a lot of people lose money this year chasing the news and bankrupt companies and pumping and dumping. And the coronavirus provided some amazing opportunities on companies that we know will be here in the next 50 years. But as normal, people chase the quick money. If you're going to chase the quick money, you need to have that portion of your portfolio set aside and realize the type of risk that you're putting it in. That should never be your main goal as far as to increase your portfolio or use that as your come up. Understand that this is going to be high risk money and be prepared to lose it. The benefit of investing over the long term in strong companies that have a future is going to ensure that you buy on those lows and those highs, because over the course of time you really can't tell what's going to be a low and what's going to be a high. You can look at past predictions, you can hit the previous 5-year tab and look at the conditions and see where there is some support. But as far as for going forward and into the future, your dollar cost average is going to be a lot lower if you buy consistently versus saving up money or saving up a certain amount and then throwing it all in the market at one time. Good, strong companies always trend up over time, and buying consistently is going to ensure that you do buy on those lows whenever they may come. It saves you the stress of trying to predict them. You'll realize your dividends, and you'll be able to acquire more stock at fair market value versus buying on a high and hoping it goes higher. Most of the money that you're going to make in your portfolio is going to come from purchasing stocks at that current fair market value, not from trying to time it and catch a low. For my new investors who are getting started and want to build a base in your portfolio, please consider timing the market, not timing the market. So not to beat a dead horse here, but I want to do one more scenario. Let's say you have $1,000 a month that you want to invest. This is going to be option A. So in option A, you invest $1,000 a month in Coca-Cola over the course of 10 years. So whatever the highs are, you buy at those, and whatever the lows are, you're going to buy at those. But every month consistently, you buy Coca-Cola and you realize all the dividends, you ride the wave up, and as normal, Coca-Cola trends up. Now you're going to realize the dividends it's going to get, let's say you reinvest them, and your dollar cost average typically is going to be at a lower threshold than someone that tries and time the market. In option B, you, instead of investing $1,000 a month, you save up $5,000 and you say, okay, this is a great time, and you throw $5,000 in at one time. And you do this consistently over 10 years. The amount of return that you're going to have is going to be lower than option A, that invested consistently, because B, you're going to miss out on dividends. C, you're also going to be buying at random sporadic times, so there's no telling what your dollar cost average is going to be. Typically it'll probably be higher because you'll always be buying at higher points each time as the stock trends up over time. So your dollar cost average is always going to be trending up along with the stock you're trying to make money in. So this is just one of my favorite scenarios to use to allow you to see over the course of time that if you invest consistently, your dollar cost average is going to be lower. And that's really what you want for stability in your portfolio. So if you have any questions about the scenarios I gave, or just getting started, this is definitely going to be the video for that. I look forward to communicating with all of you and sharing ideas. So, and just to recap one more time, most of your money should come from consistent investing in the market, not from speculative gambles and the shotgun approach and throwing at the wall and see what sticks. Most of your money made should come from consistent investing in the market over time. I was considering starting a group for investors as well that follows my channel. I'm approaching 1,000 subscribers. I believe I'll be there within the next month or so. And I was considering starting a group, maybe like a Facebook group or like a chat or an email list. Let me know if that'll be something you'll be interested in. I just want to gauge interest before I go through the trouble of setting it up. As always, I thank each of you for watching. Thank you for supporting the channel. Please like it. It helps the YouTube algorithm. It helps the channel grow as well. Please consider subscribing if you'd like more from me. Thank you again. Happy investing, and until next time.